China just yanked the emergency brake in the middle of a silver stampede, and the most crowded silver trade in the country hit a hard 10% down limit in a single day. Not because silver suddenly died, but because speculation got so hot that the people running the product basically said, stop, you're going to hurt yourselves. And when a market has to protect you from yourself, that's not a normal bull market anymore. That's a frenzy. Today, I'll show you what actually happened, why this is bigger than one fund, and what the next move usually looks like when premiums detach from reality and the crowd realizes the exit door is not as wide as they thought. What the fund is, what the crowd did, what the manager did, why the Regulators panic headline exists at all. And the one mechanic most people don't understand, the premium trap. And yes, this connects to silver itself, because the backdrop here is insane. Spot silver just printed a record high around $72.70 this week. So if you're thinking, wait, record highs and China's silver fund crashes? Exactly. That contradiction is the story. China has what's being described as its only pure play silver fund, the UBS SDIC Silver Futures Fund, LOF, and it just slammed into a maximum daily drop of 10% on Thursday. That 10% isn't, oh wow, it fell a lot. In many Chinese products, 10% is the rail. It's the limit. It's the you are not allowed to fall more than this today level. So it didn't drift down. It hit the floor. Now here's the part people miss. This wasn't random. This was after a run where the fund had been smashing into its 10% up limit for multiple days. So the crowd experiences this like a movie. Day 1, easy money. Day 2, it keeps going. Day 3, it can't lose. Day 4, limit down, full stop. That emotional whiplash is what creates panic headlines. Now, here's where this gets interesting. The fund's manager wasn't quietly watching. They were issuing rare warnings, basically telling investors that gains were becoming unsustainable and that the fund's trading price had drifted into dangerous territory versus what it actually owned. And then they did something that should instantly tell you how heated this got. They tightened the rules. Specifically, they cut the subscription limit for a share class that's popular with short-term traders. Class C down to 100 yuan starting December 26, from 500 yuan before. That's not a vibe. That's not a suggestion. That is the manager saying, we're choking off the hose because you're turning this into a casino. I want you to picture a simple scene. You walk into a store. There's a product on the shelf with a price tag, $100. But behind the counter, the store owner says, by the way, the ingredients inside that product only cost $60. That gap between shelf price and what it's made of is the premium. In fund terms, the ingredients are the net asset value, what the fund actually owns. And the silver fund's premium went from kind of normal to are you serious levels. By Wednesday, reports described the premium around 62%, up from roughly 7% at the start of the month. People weren't just buying silver exposure. They were paying a huge extra fee, not to the manager, not as an expense ratio, but as pure hype premium in the market price. And hype premium is the easiest thing in the world to destroy because it's not metal, it's emotion. So why would smart adults do this? Because crowds don't buy spreadsheets. Crowds buy momentum, social proof. Everybody's getting rich except me. And the most dangerous sentence in markets. It's different this time. And this year, silver gave people the perfect setup for that mindset. That fund was up massively on the year, nearly 220% by the reporting, while Shanghai silver futures were up roughly 128%. When normal people see numbers like that, they don't think, volatility, regime shift. They think, I missed the first move, but I can catch the next. And that's how you end up paying $1.62 for $1 worth of underlying exposure. Why China gets extra sensitive about this. The regulators panic angle. Now, about the headline phrase, regulators panic. Let's be precise. The reporting emphasizes moves to quell frenzy warnings, restrictions, tighten subscription rules. That's not a press conference where someone screams, panic. It's more subtle than that. It's the Chinese market version of, we don't like this kind of retail pile-on, especially when pricing disconnects. Because when a crowd stampedes into a narrow product, two things happen. The premium inflates and retail gets trapped, paying the markup. The unwind becomes violent because the same crowd tries to leave through the same door. So when you see repeated risk warnings, subscription caps, trading halts, intraday pauses being discussed in market chatter, cooling measures language, that's the ecosystem sending a message. Slow down. Not because they hate bull markets, because they hate uncontrolled crowd dynamics. Wait, silver hit record highs. Why did this fund crash? This is the part that separates news readers from market readers. Silver itself was ripping again. Spot silver printed around $72.70 and was described as tracking toward its best annual performance since 1979. So why would the fund drop 10%? Because the fund wasn't just silver. It was silver plus premium. When the manager tightens subscription rules, the market immediately starts to reprice the premium. And the premium can collapse even if silver stays high. Let me put it brutally. Silver can do nothing, and your investment can still get wrecked if what you bought was mostly froth. Imagine being the retail buyer inside this. You see it go limit up. You feel smart. You feel early. You feel like you finally found the cheat code. Then you see it go limit up again. Now you're not just happy, you're emotionally committed. You tell a friend, maybe you post it, maybe you average up because it's working. Then it goes limit up again. Now you start thinking, this is the one thing I can't sell. And right there, right at the peak confidence moment, is when the market usually flips. Not because the world ends, but because crowds overpay, and overpaying has a receipt. So when the product hits a 10% down limit, it's not just price, it's the crowd's identity taking damage. That's when panic becomes real, not in a regulator's office, but in a million phones. Okay, now zoom out. This story isn't China fund drama. We're Kankly. This is a signal flare that silver has entered a phase where global interest is high, volatility is high, and retail wants the silver button they can press easily. And when retail demand meets a product that is scarce, narrow, or structurally hard to arbitrage, premiums explode. You could call this a plumbing issue, a product design issue, a market structure issue. But emotionally, it feels like the price is lying. Sometimes the price is lying, not about silver, but about your entry. Because you didn't buy silver. You bought silver plus crowd markup. And China just gave you a live demonstration of what happens when crowd markup gets policed. There are two kinds of cooling. Cooling type A, price cools because the underlying commodity cools. That's normal. Cooling type B, price cools because the premium collapses. That feels like a crash, even if the underlying stays firm. This event is screaming type B because the reporting is explicit about the premium risk. The fund's trading price had a huge premium over the underlying silver futures contracts it tracks. And warnings said that could lead to sharp losses if futures reverse. That's the premium trap in one sentence. When the premium is high, you don't even need silver to fall for you to lose money. You just need the premium to return to normal. And normal feels like violence when you're used to euphoria. Signal 1, do the restrictions tighten again? If you see more subscription caps, more warnings, more cooling language, that means pressure is still high. Signal 2, does the premium compress for real? If premium drops sharply, then you know this was a valuation reset. Signal 3, does silver itself hold up while the product shakes out? That's the most telling outcome because it says the metal is strong, but the crowd got punished for overpaying. And that's how markets teach people without changing the long-term trend. This could cool off hard. It could stabilize. It could rip again. But what we can say based on what happened is a product got so hot that the manager publicly warned the crowd and tightened access. And the next day, the crowd got a 10% limit down slap. That's a real event with real consequences. No prophecy required. So what do you do with this practically? Never ignore premiums. If a product trades far above what it owns, you are buying air. Limit up streaks are not proof. They're often the danger sign because they attract late money. Rule changes matter more than vibes. Subscription caps, repeated risk notices, those are warning flares. If you want silver exposure, know what you're actually holding. Is it the metal? Is it futures? Is it a fund that can detach from NAV because everyone piles in? If you can't answer that, you're not investing. You're guessing. Real panic isn't a dramatic headline. Real panic is administrative. It looks like warnings stacking up, access getting restricted, products being forced to cool, the market quietly saying, enough. That's why this matters. Because it tells you, silver isn't just rising, it's becoming a social event. And social events in markets always overshoot, up and down. Here are 3 grounded scenarios from here. Scenario A, premium reset. Silver holds. The fund premium compresses. The fund whipsaws. But silver stays firm. That's bullish long-term, painful short-term. Scenario B, everything cools. Silver dips, the fund dips, the crowd leaves, premiums normalize. That's the market cleaning itself. Scenario C, the crowd pauses, then comes back. If silver keeps printing strength and retail re-enters, we get another wave. But the next wave usually comes with tighter controls and sharper volatility because the market remembers. Let me end with one real question. If you were holding that fund while it hit limit up 3 days in a row, would you have taken profit? Or would you have told yourself, I'm finally early. I'm not selling? Be honest, because the answer tells you what kind of player you are in this market. China didn't kill silver. China just reminded everyone that when speculation detaches from structure, structure always wins.